Hello, everybody. Welcome to week 50 of 2025. This is the Build Weekly Roundup, and as always, you have myself, Cameron Otsuka, and Matt Dines here to talk through the key topics that we've seen over the past week. So, just kind of to walk us through the topics that you've seen on the initial title slide. Number one, the Fed announced the begin of what they're calling reserve management purchases. There's been a little bit of chatter online already, but I'd like Matt to kind of explain a bit what they are, and then maybe where else to go to see Matt talk in depth on what's going on there. Number two, then, for today's topics, Russian oil. There's some new news regarding Lukoil, and then broader picture. What does this look like for what's going on between Russia, the EU, U.S., Ukraine situation ongoing, and then we'll round out today's episode with J.P. Morgan publishing a rising cost outlook. We've reused our man looking perplexed over his laptop because, again, I think that would be, if I was a big bag holder of JPM stock, I'd probably be having that same facial expression after that announcement came out. So, without further
Uh, J,
ado,
J,
yeah,
JPM will be fine. I think, yeah, that's a man stressing over the numbers in the spreadsheet.
yep.
I think is what we're looking at. U.S. office worker in a suit. Um, cool.
So yeah, without further ado, let's go ahead and flip right into this. So, first off the gates, I'm going to put up the initial announcement by the Fed here about uh, reserve management purchases operations. Maybe Matt, can you describe what this is? Why is it a difference or a change or a new facility, new program that they're opening up, and how does that kind of relate to what you're seeing in the bond market as well?
Yeah. So, I don't know that this is necessarily new, other than the fact that we have a new acronym for a specific program that the trading desks are conducting at the Federal Reserve Bank of New York. So, what this announcement was, we knew that we were getting a wind down in QT, which, as most people are probably well versed, 10 to 15 years into this QE, QT toggling framework that we've become used to. End of QT means the Fed is done letting the bonds it owns on its balance sheet, both predominantly treasuries and mortgage-backed securities, mature and run off, as in like they don't reinvest those cash proceeds that are matured, right? They will just let the private market go out and fund those bonds, a bank, a pension, private sector households, businesses, etc. So what we've seen starting December 1, if you recall the last Fed meeting in November or October, we got the announcement that QT would come to an end on December 1. And then we got the announcement at this meeting, we just heard on December 10th that as of today, Friday, December 12th, there would be this new program and name or acronym, the RMP. The Fed would begin conducting systematic purchases of treasury bills through its trading operations desk, right? So what does this amount to? I didn't put this slide in there, but this is, effectively similar to what we've seen in some of the other eras. I think the most similar in modern times would be September, October actions taken to kind of quiet down the repo rumble. If you recall back in those days, the policy was an injection of $60 billion in cash, which were effectively purchases or were in practice just purchases of 60 billion in treasury bills on the front end to provide the liquidity that overnight repo markets, that the young SOFR, which was really just getting out of its diapers at that point, the liquidity that it needed at a time of stress. And if you remember, second half of 2019, what followed as we turned into the new year, things got interesting really, really quickly as we turned into 2020. So if you think in context now, 2019, you were at $60 billion for a very similar program on, if you look at the T-bill structures, you've got a 1 month T-bill, 3 week, 3 month, a 13 week, which 3 month, 26 week, and a 52 week. This is back in 2019. That was about $200 billion in treasury bills that would just need to be constantly rolled over. The 52-week treasury bill, that auction takes place once a month, but everything inside of that, those roll through once a week. We're just running them hot. Since 2019, we've added multiple additional standing, T-bill auctions. So now we have an 8-week bill or a 2 month. And we've added a 17-week bill or a 4 month just to that regular weekly cadence. And this is part of that broadly observed trend that commentators have noted, which is the increased usage of bills funding for funding federal deficits, right? So that's part of this process. And if you look at the US Treasury yield curve, what does this mean in practice, right? Remember back in 2022, 2023, when monetary policy was focused in on reining that inflationary impulse, we got the front end rates up to 5.5%. That brought the commodity complex into a rollover as we got into the second half of 2022. And kind of ever since then, we've been on the downhill slope and working out that inversion in the yield curve. This last cut from 3.75 to 4, now we're at 3.5 to 3.75. This last bit is basically what's going to happen with the Fed coming in to purchase treasury bills. What that's effectively doing is moving up price on these bonds, or the mirror image of that, the other side of the coin, is bringing down discount rates on those bills. That's effectively wringing out that last bit of inversion in the yield curve. And from here forward, as these $60 billion monthly purchases take hold, which is also a balance sheet expansion from the central bank, it's not long duration coupon bond expansion. It's expansion at the bills end and primarily showing up in the money markets. What that's effectively doing is normalizing that yield curve to be fully sloped, positively sloped throughout the entire maturity spectrum, from overnight rates all the way out to the 30-year long bond. Or even equivalently, if you get into the swaps market where banks will trade off or add or lay off risk, like duration risk between themselves, trading fixed for floating agreements as credit counterparties fully collateralized by US Treasuries, you'll start to see that positive slope work its way throughout the system. Now, what does that do? That incentivizes, say a bank can borrow at 3.5%. They can go out and buy, 2-year, 5-year, 10-year credit, however much further you go. This is where you'll start to hear the term premium argumenters pop up on X, as this goes on. You'll start to see that positive spread show up throughout, both the yield curve, but also working its way into credit originations as this continues to move forward. So that last little bit, those last 25 bips, are huge because what it means for, let's say, a bank who does a fixed income origination, say they don't have. Say they're a dealer, right? And they don't have the balance sheet capital to immediately fund the loan. Where do they go? First source of financing is going to be to repo, right? Hit the repo markets. And with that positive spread throughout means, everything from here forward until we hit the bottom of the cycle is basically going to be riding that positive carry. So from here on out, we're looking for credit expansion to pull the plane up, if you will, and navigate the landing. I think we talked about hard landing, soft landing, no landing for, man, it was like 2 years in there, and then the discussion quieted down. But this is the window here. These next, let's say, 3 months, 12 months, somewhere in here is the landing. So we'll get a chance to see what that looks like. I had a talk, regular conversational update with Nick Bhatia on the Bitcoin Lair podcast. I highly recommend Nick and the work that his fantastic outlet does in describing this navigational or transitional monetary era that we're living through. He does it in a very objective way, with a very thoughtful academic approach, I would say. that you're generally not going to see from other third-party research providers or sell-side coverage desks. So tune into Nick and the Bitcoin Lair if you're not already. Highly recommended. But Nick and I go deeper into this topic yesterday on both Fed policy update for the outlook as of Wednesday. But then we get deeper into the what I think is really the straw stirring the drink right now in sovereign debt markets, which is what's going on in Europe. So Cameron, we should be able to get a little link plugged right up here in the top
Yeah,
corner
yeah. If
in
I'm able to
the
figure this
YouTube
out,
video.
it's gonna be right next to my head. So go ahead and click on that, and that'll take you to where you gotta go. Otherwise, it'll be in the description box at the bottom of the video.
All right, we're content rookies over here, just starting to figure out. We're about a decade behind, but we'll get there. But yeah, great podcast. We do discuss that further on a conversation. So we'd love to have you all tune in for that. Um, so on to what I view as a very important topic in global energy markets. Footing back to the framework of energy, raw inputs, metals, commodities, increasingly becoming important as these legacy fiat credit monetary systems, um, basically rush for collateral at the base layer to reliquify the debt that's been built up in their own sovereign denominated currency units. We've got a big story here over the last 2 months with the Russian oil sanctions, in particular the U.S. Treasury's forced divestiture of the Russian majors, Russian oil majors' international assets. Now, what do we mean by a Russian oil major? Think of this like if you're in the U.S., it's your Chevron or Exxon. Or if you're in Europe, think of Shell or Total Energies. But what the majors do is they're primarily involved in the cross-border, commodity flows of oil and potentially natural gas. But natural gas is a very new and emerging commodity in cross-border international trade. Oil, this story goes back, 120 years. We've had oil tankers since Marcus Shell, I think it was, came up with that invention and did the corporate roll up of Shell Oil, a British oil company, and combined it with Royal Dutch Oil to, form the company we now know as Royal Dutch Shell. But yeah, we've had oil tankers to transport oil from A to Z. We'll get into a story on that in a second, and connect some dots here, hopefully for you all. But what we saw in this Scott Bessent issued directive for Lukoil and Rosneft to sell their non-Russian, non-domestic oil interests. So could be gas station networks, could be pipelines, could be refineries, could be exploration and development projects. Those had to be sold with a deadline of December 13th. Now, as of this week, we got an extension on that deadline. It's now 5 weeks from now. We're looking at a January 17th drop dead date. And we've now got a story shaping up on how this could play out. So far, this looks like the most reasonable option, and we'll get into that. So I think media reports have mentioned there's been 12 bids for these international oil assets. It's been a very messy process. This is something that is very difficult for a buyer to come in and complete its due diligence on in a 7-8 week period. That was essentially what was provided under that original deadline, right? So, and you're also dealing with a situation with internet asset sales, jurisdiction, property rights. It's legally gray here. And if any industry knows what it's like to have their property confiscated or just general ambiguities of dealing in an unclear regulatory environment, the oil majors know what they're looking at here. So this is a very difficult thing to get done in a tight deadline. And I think we've got kind of a solution starting to take shape. So there's a firm that showed up, and people have been watching this story over the last decade or so might be familiar with this name. But this Xtellus Capital Partners um, showed up with the preferred bid among the 12, or I don't know if they said they had 12 other bids, which would make it 13, but 12 or 13 bids. This offer or proposal is essentially what Lukoil has said it leans towards, or it would prefer. When we say leans towards, this is a messy situation here. Essentially what you're looking at is a divorce type of scenario. You've got lawyers in the middle. Everybody's trying to figure out who's going to leave with what are some fair terms. But then also the lawyers themselves have an interest in the matter. So it's even messier than a messy divorce, if you can believe that. So if any of you have friends going through those type of situations, it's that level of stress that I think these people involved in the offices are having to deal with. So this is a cashless bid. What do they mean by that? What Xtellus is proposing is essentially an asset swap. So you've got a bunch of Lukoil shares. These things trade on the Russian exchange. It's about a 50 to $60 billion market cap. Could be higher, could be lower. Obviously, prices are going to be distressed, just given the state of Russian international relations as things have gone the last 10 to 15 years. But you're looking at, let's call it 50, $60 billion. The estimate of the international assets that are in play in Lukoil's portfolio are roughly $22 billion is what you've seen. Now, of Lukoil's parent shares, the whole pie, about 25% of that, of the shareholder base is owned, or was owned. Currently, these things are frozen, as is everything related to Russia at this point. That touches the Western financial systems. 25% is owned by U.S. investors, right? And that list includes BlackRock, JP Morgan, Goldman Sachs. Just work your way down the list. Lukoil equity, if you're looking at 2020, 2022, that type of time frame, these things were trading at, extremely suppressed PE multiples. Valuations were already low. All right. So what do you have right now? You've got a bunch of U.S. broker dealers, asset managers, et cetera, who are just sitting on these, property claims on behalf of their owners, which are going to be U.S. based investors for the most part. That 25% would be the consideration from the U.S. side in this deal. And then those international assets would then spin out and sit in a new container, right? And that thing would be overseen by this Xtellus Capital Partners. Over time, short term, right? This has to get done sooner rather than later. Those international oil assets would then be kind of piecemeal carved out to their ultimate buyer, which would most likely be a U.S. oil major such as Chevron, Exxon, et cetera, or it could be a U.S.-based private equity company that's been mentioned, like a Carlyle Group, something like that. But that's generally the framework for how this, messy knot can get untied here, with everybody. I don't want to say leaving happy, because nobody's happy when they have gun to their head, someone forcing them to rid themselves of their property. It's never going to be a welcome situation. But we at least have a man in the middle here where we can structurally get something done without making a bad situation any worse, hopefully. So that's what we're looking at with the Russian Lukoil and Rosneft scenario. Now, this Xtellus Capital Partners, if you want to look into their history, they've got a legacy parent company, VTB, which was fully owned by a Russian entity. So there was a direct link to the Russian financial system since I want to say 2017 or 2018. And as a result of the sanctions buildup towards Russia that had been ongoing since the early to mid 2010s, that link was severed, and this group called VTB spun off into Xtellus Capital Partners. Literally the same CEO, mostly the same personnel, just different legal entities, binding this whole thing together. So that's how we have this new middleman. Hopefully, this leads to at least a positive resolution, or at least something that is legally defensible without harming the United States reputation for defense of property rights, assurances, and protections that make it at least viewed in perception as a friendly place for international capital investment. So that's what we're dealing with here. You see on the company's website, literally like largest text. What stands out here? Xtellus is a New York-based broker-dealer and specialist investment bank. All right, New York-based, that tells you something. And then below that, I'd say we mobilize cross-border capital to deliver growth and long-term value. Cross-border, the key thing there. So that's the entity we're working with. Remember how we talked about a couple of weeks back in our update, the Gunvor proposal, the Swiss-based commodity trading house with Russian-friendly ties. This is the next best option from, let's say, the Russian perspective on the side of this transaction. And notably, kind of fulfilling the requirements of the OFAC directed divestiture. Can't deal, this transaction cannot operate through the US dollar, domestic financial system. So you're looking at a cashless asset swap to get this done. We'll see how this goes, but it actually looks like it may be able to work itself out. So that is, in some sense, a positive development. Cameron, any thoughts there, or
I
you
remember
want to move
coming
on to the
across
next
this,
story?
and
And
yeah, I thought your description of this is really tied it together for me. I think for our audience, I saw the Lukoil headline. I clearly read through the Xtellus piece and thought, this is an interesting company. Don't know much about it. For more specifically, though, the terms of the deal just really didn't make sense to me in terms of why this would be a beneficial, piece, at least on the Lukoil side. But Matt, kind of explaining through the rails that you need to use or you're not allowed to use in this specific transaction, things like that, it starts to make a little more sense why you need to have some type of a buffer, right? A middleman in between the two. And it also makes a lot of
Mhm.
sense why Lukoil is going to prefer something like an Xtellus over, one of these other potential partners that maybe aren't as closely tied to their political affiliations as the other ones are.
So the net of this whole operation, I think if you're looking at this from the big picture, what does this net out to? If you look at the oil majors, I mentioned them: Chevron, Exxon, Shell, Total to some extent. Um, the Russian oil majors are essentially depeg, like they're moved a peg down, right? You're going to be left with a Lukoil and Rosneft that are stripped of their international assets, right? The comp after this is basically from a U.S. standpoint. What's an analogy? It's like a Valero, a Marathon Petroleum, someone like that, where it's focused on domestic production, domestic distribution, domestic pipelines, and that sponsor, which really flies under the flag of the sovereign, in this specific global oil market, is essentially taken off the board, right? So you've removed a competitor in international markets. You get to the theme of it's in the word of the book, the prize, right? You're out of the you're out of the
Right.
race. Um, so I think that's the net effect of this. Who wins? Probably going to be the U.S. oil industry who picks up the pieces of this one. Now, sometimes it's a Pyrrhic victory, right? We talked about oil companies operating in challenging jurisdictions, places where it's tough to defend your property rights, difficult to, lock in your distribution channels, all of that. It's a challenging market. These stories happen all the time. I know in our lifetime it feels like this is something new, but if you go back and read the prize, these things
Been happening for a long
pop
time.
up every few decades. Yep. All right. So on to and if you go back and read that, you can see the history of the Russian oil industry. This is just basically par for the course. They've never been able to get out of the box that their geographic location just basically limits them to. So it's a challenge for Russian industry, as it really always has been. All right, so on to another oil story. I don't want to say that the Venezuela situation is all about oil. I do not believe that's true. If you look at, that general framework, when you see geopolitical action, the last time I heard this, and I was a 14-year-old kid, when the second Iraq war came out in the aftermath of September 11th, the let's say the contrarian position to oppose that second Iraq war was really the George W. Bush administration is in this for the oil. If you look at history, the way this has played out since, I know it makes sense. Dick Cheney, as a Halliburton executive involved in the oil field services business, seemed like at the time, yeah, that incentive makes sense. In terms of how it played out, that narrative or reasoning to oppose, whatever's going on in the big picture, um, it was a terrible kind of framework for even figuring out at all what the heck the second Iraq War was even about, right? If you look at Iraqi oil production, all of that, it's just been there's no proper reason why you can justify the trillions that the U.S. spent on that war for those oil resources. It just doesn't make any sense on the face of it. All right. So why do I bring that up? We're seeing this build up in Venezuela. Cameron and I think we've been talking about this for several months
Yep.
now. Maybe August, we first started talking about this build up. You do start to hear, hey, we want their oil. Venezuela's got the largest oil reserves of any country in the world, et cetera, right? I don't know that that's the be all and end all. We don't necessarily want those reserves, in my opinion. It's not about confiscation of those resources, especially when you're looking at a U.S. Domestic oil industry that's now become a net exporter or a net producer, as opposed to a deficit oil consumption nation, post shale, technology boom. So that aside, I won't go into like the thoughts on what I think is actually going on here in Venezuela, other than it's pretty clear, two things. It is related to the international commodity flows. So the oil and where it's going do matter. And then you think about um, the financial value of those commodity flows as a collateral into a fiat-based credit system. That is important here. And then I would say number two is the relationships between sovereign states, both between themselves as we break apart this unipolar order that we've been living under since the fall of the Berlin Wall into four regional spheres, essentially. Um, I think there's some element of those regional spheres interactions with each other and access to commodities, but then also there's pretty, I don't want to go out a limb here and say this, but I think this is also intelligence related in terms of these networks where they have business operations. And I think you're looking at this fight move down to that intelligence layer. Now, do I expect a full war, boots on the ground? No, I don't think that's going to happen. I don't think that's the deadline on where this goes. But all right, that aside, we'll begin to see more of what this thing is about as this story continues to develop. But this week we got a big update on the story, or a new milestone to match the buildup in military resources, which have been primarily naval and air support at this point. You saw the U.S. military seize this Venezuelan oil tanker, the skipper. You can see it in that image below.
This great little X-ray looking image. And
Yeah.
then this statue here.
Um, oh yeah, that's so the X-ray has a ship-to-ship transfer of the oil, which is under sanctions, right? And then you can see the routes that this vessel is taken. It's doing business from Venezuela to China, Iran to China, Iran to Syria. And so you start to see the commodity flows of where these resources are going, um, which is really, remember we talked about the word, what is marketing? It is really the connection of supply and demand in these global international flows of commodities, right? Um, that's, a big tell on what this Venezuela situation is likely about. So new front opened up in this broader clash of civilizations that we've been building up to, at least since 2008 and the GFC. You could say the timeline really kicked off with September 11th, if you want to roll back far enough. But the same way we heard of 2 weeks ago, right? Headlines: Iran commandeered an oil tanker off the Hormuz. We're seeing the same thing now in Venezuela. So interesting thing to watch. But this kind of signals what this, how this Venezuela situation plugs into that monetary story that we really try to cover as we go through this era of transition.
And in your mind, Matt, would this also maybe relate to this quote that you put together here? Explain this one to
Yeah,
me. How does this kind of fit into that broader picture?
exactly. So you think about those commodities channels, right? Go from A to Z. The key thing for an economy is access to natural resources, right? The goods that it needs to obtain to continue to operate and grow, right? So if you look back at history, where did you see, go through the Napoleonic Wars as a good example? Where did you see one side really prevail? What was that key advantage? And you go, like, look at this quote on Napoleon. Like, he's viewed as one of the greatest, like among the greats of land-based military strategy of all time. Like, we're talking Julius Caesar, Alexander the Great, like he's up there, right? What he didn't have and didn't appreciate is the importance of naval power, right? You go back and you replay the tape on, um, you know, why his, advance towards uniting the European continent ended in defeat. Goes back to the story, in my opinion, of the failure to meet English naval power. So his quote: "If it had not been for you English, I would have been emperor of the East." What he means is China and the trade routes is really what he's talking about. But wherever there is water to float a ship, we are sure to find you in our way. So that's the key thing here. Think about these things: the naval um, commandeering, the U.S. Navy commandeering a Venezuelan oil tanker, right? If you can do that in, let's say the Caribbean Sea, you can do that in the Gulf of America. Like, you actually have geopolitical power. right? That is the key. If someone else was in the way and could prevent you from doing that, they would be the emperor of the East. They would be the emperor of South America, et cetera. So this is the uh, what's the right word? The trump card, the difference maker. Like this is the competitive advantage. I just want to call that out. As we're watching the naval buildup, take place, and we progress further through this geopolitical conflict, goes through the same thing with the Russian oil assets, right? If you can't actually go from, where are these things located from a supply standpoint? Kazakhstan, the
Bulgaria.
Baku, yeah, around the Black Sea. If you don't have the naval power to, uh, move those goods on waterways or let's say even land-based pipelines, you can protect the pipelines. That's also difficult to defend. Um, if you don't have control of the shipping lanes, it's basically impossible to win this game, right? So that's what's going on. That's what we're looking at. And just wanted to put that in everybody's minds as we're watching this current version of history unfold with a rapidly evolving situation in Venezuela.
And I thought, in a corollary to this, kind of from the financial side of things, what we're seeing going on with the EU, I saw this headline: EU greenlights the indefinite immobilization of Russian assets. And I just immediately pinged this over to Matt because, what I believe it's on Monday, they're supposed to vote in terms of what they want to do with these assets. But uh, Euroclear is headquartered in Belgium. They very much, at least up until today while we're recording, they very much do not want to go through with this and freeze Russian assets because as a custodian, that does not set a good precedent for the rest of your bank or your custody partners, right? They are not going to necessarily trust that they can hold funds with your facility if you could just get overruled by the EU. So a lot at stake here, but I did think, Matt, as you're talking through all of this going on with oil and commodities, it just seems to me like this is the EU attempting to do the same, but using the financial rails instead as the commodity that they're trying to control, the route they're trying to control.
Yep. Um, it's hard not to be so it's hard not to compare this to the situation with the forced divestiture of oil and gas assets. But I think a key difference is the US is trying very hard to come up with a solution while still respecting property rights. It's very tough
That's
to
a yeah
do,
key point.
right? We're splitting off, we're trying to get divorced, trying to not escalate this, for this war from escalating any further. And yeah, just basically trying to find Solomon's solution to not split the baby, right?
Right.
No one's going to be happy. The European solution, what they're sitting on is Russian reserves, right? All of Russia's foreign reserves, you know, are the euro denominated and dollar denominated are going to be held at European banks, right? And so what this reflects is basically completely torching your trust relationship as a counterparty, right, or as a custodian. Um, so I think in terms of are these situations an apples to apples, like on first view of the headlines, sure, maybe they seem similar, but actually when you get into the details and potentially stoking irreparable harm to a relationship, maybe I'm biased here, but I think the Americans are trying to preserve their sense of property rights, respect for rule of law, etc., whereas the European Union just has something they want to get done, which is use these Russian reserves, these assets, to fund the war in Ukraine, right? So different situation, but both of them are effectively netting out to the same thing: the regionalization out of that unipolar world we lived in for just a brief moment in time. Um, and we'll see how this goes after the fact, as this week has evolved in terms of the headlines. We didn't feature this as a top three story. It probably should have been. Um, but remember how we talked about this window we had to find a peace in a tri-party agreement between Russia, Ukraine, and then the United States as a middleman? That's off the board. It's not happening. You saw Zelensky as a representative of Ukraine's government meet in London this week with Keir Starmer, Emmanuel Macron, and Friedrich Merz from Germany. And basically, the writing on the wall was they're not going to take part in this framework on terms that basically line up with Russia's offer. So essentially, there is no split of the bid ask. There's no peace deal to get done between Russia and Ukraine at this point. It was what it looks like, which is probably a sad thing for all of humanity in the end, as we march down a path that most likely does not end well at all for anyone involved. So, yeah, I think we're looking at a context. Obviously, Russia is the one left holding the short end of the stick on all of these, as they definitely expected to be. They were never going to get, uh, well treated by either the European financial system or the American financial system and political system in terms of sanctions. But in terms of, respect for property rights, I don't know that there's a good way or fair way to do this from the U.S. and Russia side on the oil assets. On the financial assets, where it's just a pure or it's a pure credit claim on someone on a currency unit, um, those are basically trampled and gone. So I don't know what else to say about this. It's not a positive development. This isn't something we should all um, celebrate. You've seen videos from NATO Secretary General Mark Rutte basically rallying or trying to rally the European societies to sign up for sending their youth to the front lines in an escalation of this war. Um, and it's just hard to see a positive outcome coming out of any of this. So I guess we'll just leave it at that.
Yep. Yep. All right. Well, on slightly less sad news, but still sad news. Uh, JP Morgan award of higher than expected costs, and I'll be first to admit I don't fully understand exactly what's going on with what JP Morgan is trying to talk about here. So I'm gonna just let you explain to me, Matt, as a slightly informed but very unknowledgeable person on this. What is going on? Why are they concerned about these higher than expected costs, and kind of why the market reaction? Why is this making headlines?
Yeah. So if you look at it, it's just, yeah, what are the costs to run their business? People, servers, buildings, all of that. And I think what you're looking at here, obviously JP Morgan in essence is, not just a bank, it's really a technology company that in terms of R&D budgets and tech spending, it's up there with, what we view as a tech company. Maybe not
Absolutely.
quite a Google or AI focus, but they spend a lot on tech. And I think Cameron, our story last week about the supply constraint that the AI trend has run into, memory costs, for example, like as the key one with Micron dropping out of the consumer market. That's showing you the AI trend, the technology infrastructure to support that movement. Like we're right up against, our own constraints for the U.S. economy to deliver supply and resources into that demand. So J.P. Morgan is going to be feeling that headwind as well, same as every other producer who is building out, let's say, technology capabilities, memory, servers, cooling, semiconductors, everything that goes into server racks, et cetera. data centers, all of that. There's a lot of that spend at JP Morgan. It's not the hyperscaler, it's not a 18 football field length facility, but some of that increased cost is tech. Some of that is just cost of headcount. They mentioned, say just middle and back office, right? I think they gave them a bonus. I can't remember the figures off the top of my head, but it's basically just a year-end bonus for all of its, tens of thousands. I don't know exactly how many employees, but if you think about your rainmakers, your deal makers, your just the MDs making massive paychecks, working out of the home office, pictured here, the JPM headquarters. That's a small share of the total workforce of JPN. There's a lot of people who just work at the local branch bank. They're feeling that same, pinch on their own personal budgets from rising costs. That's impacting the rest of the lower and middle class in the U.S. economy. So they did issue a cash bonus for 2025, a couple $1,000s. I forget the exact amount, but it was meaningful across a massive employee base. And if you look into this, guidance, it wasn't a detailed spreadsheet. I think they said, hey, we're expecting, I think it was like 105 billion in cost as opposed to 101 or something like that in terms of the uptick, something along those lines. And there wasn't too much more given beyond that. They just mentioned, three or four line
Yeah.
items, but didn't break out totals or forecasts or anything like that. It was basically those things I mentioned: headcount, staff related expenses, technology, all of that. You're just looking at higher costs, right, to run the bank. And this is where, in an inflationary environment or rising price levels, um, go back and read Warren Buffett's shareholder letters in the 70s. It is difficult for, business and enterprise to basically preserve value in an environment where their, denominated unit of activity for transacting in an economy is debasing. It's a huge challenge. So this is your number one bank. This is your flag bearer. When they raise this concern, it's even more pressing for everybody involved in this industry on smaller scale, I would say. So
Makes sense.
that is what we're looking at.
Yeah, this is just one
Um,
where the headline is what it says on the tin. So got it.
yeah, exactly. And then one more quote from Jamie Dimon. He was at a conference, speaking up on a panel, and he mentions, specifically in his comments that Europe has a real problem. And that goes into, if you want to, hear more thoughts about this, we're about time for wrapping up. Um, but this relates to the geopolitical situation at hand. Um, we basically walked in. We're right up on the brink here. If everybody's following this situation at home, I know it's tough to understand what's going on in the confusing world of finance, geopolitics, fracturing of the world order, all of that. Um, but Jamie Dimon, one of the most widely respected people in American, not just American finance, but just business in general, specifically says Europe is like a weak Europe is a risk for the United States. I think we could unpack that very deeply, but I'll just, refer everybody to the conversation that Nick Bocci and I had yesterday, which is up on his channel. You can find it on YouTube at the Bitcoin Lair, um, and get deeper into that European sovereign debt, the euro, the ECB, everything going on. But yeah, those comments from Jamie Dimon, he said stuff like this before, but just given the moment, everything happening, it's really, it's turning on that bright Klieg light and putting the focus like right on the topic.
Absolutely. Well, with that, I think just a reminder, just like Matt just called out, please go to the Bitcoin layer, watch Matt, talk with Nick. That's on my watch list for the weekend as well, so make sure you go through that. We'd really appreciate it. And then also, as always, you can follow us on X, on LinkedIn, on YouTube. Feel free to subscribe, recommend us to your friends, your family, whoever else. Share the videos if you think they're good. We appreciate you all watching. So thanks again, and see you all next week.